Welcome to video 14B as we continue our journey through using your house as something more than a house. So this video talks about when we rent our homes. So the previous video we classified them, and we know that classification can affect the amount of deduction you can take and the limit that might apply to that deduction. So this video is really all about applying those rules. So big suggestion on having a calculator handy, following through as we do the calculations to the extent you feel like you need to. Otherwise, here we go. So we know dwellings can be classified into the three groups: principal residence, residence not principal, and non-residence. And we know that in number 2, the in-between classification, so the residence not principal, losses are limited, meaning you can't have deductions that exceed the income of the rental property. And in both numbers 2 and 3, to the extent there's any personal use, the cost must be allocated and classified by tier so that the appropriate amount is deducted. Okay, so we're going to go through a calculation where we take care of that. So expenses are allocated to rental use are deductible only to the extent of gross rental income after deducting our direct expenses. So this is true of the category 2. So the general or the in-between category. Expenses are allocated based on the number of days used for each activity. Recall again back to the previous video where we counted what were personal days and what were rental days. But there is an exception for Tier 1 expenses. And there's a separate method by which you can allocate those known as the tax court method, which says the denominator isn't just the total number of personal and rental days, but it's the total number of days in the year. And I'll show you how that affects the calculation in a second. And of course, expenses must be deducted in tier order. Tier 1 first, then Tier 2, then Tier 3. So at the beginning of year 1, Mr. Hand and his family purchased a vacation home for $400,000. Paid $100,000 down, financed the remaining $300,000 with a 6% mortgage. During the year, they used the home for personal purposes for 30 days and rented the home for 200 days. They received rental income of $37,500 and incurred $500 worth of rental advertising expense. And then here are the other expenses that were incurred by Mr. Hand. So some interest, taxes, utilities, repairs, kind of the run-of-the-mill, and depreciation. And so let's go ahead and try to allocate those expenses using first the IRS method, which considers only rental and personal days, and then the tax court method, which considers all days. Okay, so let's start by really just examining the left-hand column. Let's not get ahead of ourselves. And you can see that what I've done is I have listed each of the expenses in tier order. So let's look at the Tier 1 expenses in total. Advertising, $500. Interest of $18,000 and property taxes of $5,000. So the advertising cost is a direct cost, making it Tier 1. Interest and property taxes are also Tier 1 as a function of being able to be deducted otherwise as itemized deductions. So we know depreciation is the Tier 3 expense. That's down there at the bottom. And so, of course, everything else is a Tier 2 expense. So utilities, repairs, insurance, and maintenance, all Tier 2 expenses. So when we stack up all expenses, in total, it's $50,439. Well, since I know that I'm in a category 2 and that my deductions are going to be limited, so I'm in between, I'm a residence not principal, I know my total deductions are going to be limited to my total amount of gross rental income, which is $37,500. Okay, that said, let's begin the allocation. So first we'll do the IRS method only. So the first thing we would do is count the number of rental days. Well, we rented it for 200 days. What's the total number of days? Well, rented plus personal is 230. So the allocation ratio of each of these is 200 to 230. So advertising is a direct cost, so there's no allocation required. There's no part of that advertising that is personal in any way. So as a result, that's a direct expense and there's no allocation. Then I go through interest and property taxes. I allocate those two based on 200 divided by 230. So 18,000 times 200 divided by 230 is 15,652. 5,000 times 200 divided by 230 is 4,348. So now I have my total Tier 1 expenses, 20,500. Now, important about Tier 1 is that those expenses are deductible even if they exceed gross rental income. There is no prohibition on deducting all of the allocated amount of those expenses. That's simply not true for Tier 2 and Tier 3. Okay, that said, let's keep working because 20,500 is less than gross rental income. So let's keep working our way down, and we would perform the same allocation on utilities, repairs, insurance, and maintenance. So that would imply then that the total amount of Tier 2 expenses, $11,304. Okay, so it looks like we're still not at 37.5 because my Tier 1's 20,500, my Tier 2 is 11,304. So it must be that my Tier 3 pushes me over 37.5. So what that means is my depreciation deduction is going to be limited. So I take the 37.5, deduct out Tier 1, deduct out Tier 2. What's left? 56.96. So even if I do the allocation of depreciation, it's more than 56.96. Therefore, the only amount I can deduct is the 56.96. And so the remaining amount of depreciation would simply be carried forward, presumably to be used in a future year as a deduction. So as a result, my total expenses are 37.5. And I knew that answer from the beginning because I saw that my total expenses were 50,439. If I allocate that using the 200 divided by 230, I get more than 37.5. Okay, now let's shift to the tax court method. And the tax court method only affects your allocation of Tier 1 expenses. So instead of allocating based on 200 over 230, your Tier 1 expenses are allocated 200 over 365. And there's actually a pretty good rational reason for that. So when you think about something like utilities, in theory, you only spend money on utilities when someone is in the house, right? So you only pay when either you're using it or your renters are using it. And in theory, when it sits vacant, you're not really using any utilities. However, property taxes and interest accrue ratably during the year, whether the house is being used or not. And so that was the argument the taxpayer made in front of the tax court, and the tax court agreed, yes, that does seem reasonable to us. Okay, that said, we would not allocate advertising. The total amount goes through because that's a direct expense. Interest and property taxes are now allocated based on 200 over 365. I get total Tier 1 of 13,103. You can see that that amount is substantially lower, right? So at first it had 20,500. Now I have only 13,103. Well, who on earth ever wants to deduct less expense? Well, remember, no one's deducting less expense because Tier 1 is eligible for an itemized deduction. So there's a pretty good chance that the increment between 20,500 and 13,103 is now being taken as an itemized deduction. Okay, now I do Tier 2. Tier 2 is using the old method, 200 divided by 230. The tax court method only applies to Tier 1 expenses. So the same Tier 2 allocation, 11,304. Now we get to depreciation. So I have 37.5. 13,103 minus 11,304, so I deduct Tier 1, I deduct Tier 2, I end up with 13,093. But 13,939 times 200 divided by 230 is only 12,121. So I'm going to deduct my actual allocated depreciation of 12,121, which means that my total expenses are actually less than my gross rental income. So you might say again the same thing. Well, wait a second. Why would you want to report income when you don't have to? Well, look at the shift in the depreciation expense I was eligible to deduct. So now instead of only being able to deduct about 5,700, I'm able to deduct over 12,000, knowing that the differential in my deduction here is being picked up as interest and property taxes on my itemized deductions. Okay, so if we have a category 3 that's primarily a non-residence, the taxpayer includes all the income and deducts all of the expenses. However, if the property is used even one day for personal use, you must go through the allocation. And then we've already talked about the personal use of Tier 1 expenses, so I won't go through that again. So let's assume instead that the Hand family did not use the home for personal purposes at all. So Hawaii's too far away, and so it's just a rental. And they received the same gross rental income, $37,500, incurred the exact same expenses. And that's just coincidental because that way we can relate to these numbers. Okay, so how much can they deduct? Well, there's no allocation necessary anymore. So they're simply going to deduct all of their expenses, all $50,439. So this generates a loss of $12,939 on the property. Now, we know that basis at risk and the passive loss limitation could apply. So let's walk through each of those with respect to this example and kind of see why that may or may not be the case. So when it comes from basis perspective, they bought this house. So they probably almost certainly have basis in it. From an at-risk perspective, it's a rental residence and real property secured by most likely a mortgage issued by a financial institution. So that makes it qualified non-recourse financing, if it's even non-recourse financing, which means their at-risk amount is the total purchase price. So really the only way you get captured on this is the passive loss limitations, because again, a rental activity is presumed to be passive by default. Okay. So just to close the gap and remind us how this works. So if they had a $12,939 passive loss and their current year AGI is $140,000, they are active participants in the rental activity. How much can they deduct this year? Well, they're $40,000 over the threshold. $40,000 times 50% phase out is $20,000. You take the $25,000 annual amount less the $20,000 phase out, they can deduct $5,000 of that loss. The remaining amount is suspended and carried forward. And that's just a repeat of the last video of Chapter 7. And that brings us to the end of video 14b. Thanks for watching.